Welcome back to the deep dive. Okay, today we are really getting into it, digging through your sources on, well, probably the most critical tool for actually getting business strategy done. Salesforce compensation. You know, the Roman poet Ovid, he said something pretty stark ages ago. How little you know about the age you live in if you fancy that honey is sweeter than cash in hand. And in sales, that still pretty much hits the nail on the head. Look, mission, meaning a career path, absolutely vital, yes. But our sources keep coming back to it. Cash. Or in least a clear promise of cash that's the main lever companies pull to get specific things done.
And that's precisely why we're doing this deep dive today. Compensation, it's not just, a number on a spreadsheet. It's really the physical shape of your strategic goals. But here's the kicker, the thing that trips up so many companies, this constant tension between what the strategy is now and what the rewards were designed for. Management's always tweaking strategy, right? Chasing new markets, new products.
Yeah, constantly shifting.
Exactly. But the pay plan, it often just sits there, frozen. We saw this survey. It focused on mid-sized firms, maybe $20 to $99 million in sales. And it found they only updated their compensation plans about 1.8 times over a decade.
Wow. Less than twice in 10 years.
Yeah. Think about that. Your marketing, your products, maybe your territories are changing every single year, but the pay plan gets touched maybe twice.
Wow.
You end up effectively paying people to execute a strategy you might have ditched 5 years ago. It's kind of wild.
Okay, let's break down what actually goes into this compensation thing. Structurally, there are like three main parts, right? First, there's the obvious financial compensation. That's your direct pay, your salary, your commission, but also indirect stuff like paid holidays, health insurance, that kind of thing. Then you've got the non-financial compensation, things like chances for promotion, getting recognized for good work, maybe just liking the job itself.
And those non-financials, they're super important for keeping good people long-term, building that career loyalty, no question.
Right.
But today, we're really zeroing in on the money side, the rules of the game, and how those rules either help your strategy or, frankly, sometimes sabotage it.
And you know what's fascinating? Sometimes the stuff that really motivates people isn't even in the official company handbook. It's the tactical stuff managers do on the fly. Like that manager in the New York office example.
Oh, yeah, that one's great.
He saw his team getting complacent, just farming the same old accounts. So did he rewrite the whole complex plan? No. He just launched a 2-year contest. Simple. Rewarding reps specifically for bringing in new clients.
Because he understood getting new business isn't a quick hit. It takes sustained effort, more than just, a quarterly target bump.
Exactly. And then you have the even shorter term stuff.
Yeah, the real action-oriented one-shot deals. That district manager down in Charlotte, North Carolina, famous for it, apparently.
Right, like walking in waving basketball tickets.
2 season tickets, first person to land a new account that week gets them. Imagine the buzz.
Or that chartered boat trip.
For the whole district if they hit the quarterly quota. Suddenly, it's not just about the individual paycheck. It's about that shared reward, that, fun experience.
Forget the corporate mission statement for a minute, right? Sometimes the smell of salt air and free beer. That's your strategy right there.
And you bet sales volume picked up. People hustle for things like that.
But that immediate success, it brings up a bigger question for the higher-ups, doesn't it?
Absolutely. What happens when the folks in, say, Chicago hear about the boat trips and the tickets happening down in Charlotte?
Yeah. Instant jealousy, or at least questions.
Exactly. Creates internal pressure. So then management has to decide, do we give all managers bigger discretionary funds for this stuff, just to be fair? Or do we maybe test it, give bigger budgets to just a few districts and see if it actually moves the needle enough to justify the cost?
That's a tough one. Test versus fairness.
It is, and it highlights that while those tactical fixes are powerful for, like, a quick jump start, they can't fix a fundamentally broken core compensation plan. You still need that main structure to be solid and aligned with the big picture. The ship needs to be sound,
Right, the overall voyage plan.
And that plan, that sturdy ship, it has to do 2 things at once. It has to meet the company's objectives. First, motivate the team. It seems obvious, but that survey showed 70% of execs thought their plans worked.
Which means 30% didn't. That's huge.
It is. A third were unhappy. Second, the plan has to control activities, maybe steer salespeople towards better customer service, not just volume. And of course, it needs to attract and keep good people, be flexible but stable, and, not break the bank while still being competitive.
Okay, that's the company side. Now flip it. What about the salesperson's objectives? Because this is where the push and pull really happens, right?
Totally.
They want security,
Yes.
stability, a
Yeah.
paycheck they can count on week after week, month after month, regular income.
Crucial.
But they also want incentive. They want to know that if they really knock it out of the park, if they go above and beyond, they'll see it in their pay.
Yeah.
Big time.
The upside potential.
Exactly. And then there's simplicity. This one's massive. If your salespeople need a PhD in a spreadsheet to figure out how much they earned, you've failed.
Oh, absolutely. Forget the motivation if it's too complex.
This sources suggest what, like 3 combined measures? Max.
Yeah. Keep it clean. And finally, fairness. Has to feel fair. Pay needs to link to things they can actually influence, calls made, demos given, whatever, not just, random market shifts they can't control.
Which brings us right to that core conflict you mentioned.
The fundamental trade-off, yeah. You basically can't have maximum security and maximum incentive in the same plan. It just doesn't work that way.
So management's job is finding the sweet spot, the compromise.
Precisely. High security, like a big base salary, that tends to dampen the drive to really crush the quota. Go pure incentive, like straight commission. You get massive motivation maybe, but you lose control over what they're doing day to day.
And that compromise seems to be pushing everyone towards combination plans.
Overwhelmingly. That figure, what was it, 68% of companies?
Nearly 68%, yeah. Using some kind of mix.
That tells you right there that the pure plays just salary or just commission. They're becoming kind of rare. They often just don't cut it in today's complex selling environments.
Okay, let's dig into those 3 main methods then. Starting with the old school, straight salary.
The simplest, in a way.
Right. Maximum security, maximum stability for the rep, and the big advantage for the company, control. Management can easily tell a salaried rep, hey, go focus on this missionary work, or spend time training this new person, or make sure you're really servicing that existing account properly.
Yep, easy to direct effort.
The downside, it can kill the hustle, right?
Yeah.
There's no direct financial kick for going above and beyond the basic job description. And for the company, it's a fixed cost. Doesn't matter if sales are booming or tanking, you pay that salary.
So best used maybe for trainees, or when you're breaking into a totally new market and sales are going to be unpredictable for a while.
Exactly. Or jobs that are mostly about service or relationship building, not just closing deals.
Okay, now the other extreme. Straight commission.
The ultimate motivator, potentially.
Potentially, yes. The strength is that pure incentive. Often, there's no ceiling on what you can earn. Sky's the limit. And for the company, it's a variable cost. You only pay out when you actually make a sale.
Sounds great on paper.
But, and it's a big but, the loss of control can be massive. Reps on straight commission, they naturally gravitate towards the easy sells, the high volume stuff, maybe the products with the highest commission rate, even if they aren't the most profitable for the company.
Right. They might ignore long-term customer needs or skip the setup and training or just not do any of that crucial missionary work for new products.
Exactly. It focuses them laser-like on the immediate transaction.
Mm-hmm.
And if you go this route, you got to think carefully about the rate structure.
Like progressive versus regressive.
Yeah. Progressive rates mean the commission percentage actually goes up as you sell more, bigger incentive to blow past your quota. Regressive rates are the opposite. The rate decreases after you hit a certain volume, sometimes used to cap windfall earnings on huge deals, or maybe you just keep earnings a bit more stable.
Interesting. And splits. That must get complicated with teams.
Oh, definitely. You absolutely need crystal clear policies on split commissions. Who gets what when multiple reps are involved or when territories overlap. That can cause huge fights if it's not spelled out.
Which logically leads us to the combination plan, the hybrid approach.
The winner in most cases today, yeah. Salary plus commission is super common, or salary plus bonus, or sometimes all 3. Salary, commission, and bonus.
And the goal here is basically to get the best of both worlds.
Pretty much. Overcome the weaknesses of the pure plans. You get that base salary for security and control. And then you layer on the variable part, the commission or bonus for the motivation, and that variable slice. It's typically around 40% of the total pay package now, and sources say that percentage is actually going up.
So more pay is becoming performance-based.
Increasingly, yes. And within that combo plan, the bonus is a really interesting tool.
How's it different from commission, exactly?
Commission is usually a percentage of sales or margin on every sale, or every sale over a baseline. A bonus is typically a lump sum payout. It's not tied to each transaction, but to hitting a specific goal, often a sales quota for a period, like a quarter or a year,
Hmm.
or maybe tied to a specific strategic objective.
Ah, so it's more targeted, like a
Yeah.
special reward for a specific achievement.
Exactly. It's perfect for focusing effort on something specific and maybe temporary. Like, hey, we need to push this new high margin product line this quarter. There's a $5,000 bonus for everyone who hits X target on that product. It's very direct.
And that idea of focusing on specific goals, not just raw volume, that seems to be the big shift in modern compensation design, right?
Yeah.
Moving beyond just rewarding busyness.
Absolutely central. Companies are realizing that just paying for volume, well, it doesn't always lead to profit.
Right.
So the sources show, what, over half, 51% of firms are now finding ways to reward profitable sales.
How do they do that?
Often by basing commission not just on the total sale amount, the revenue, but on the gross margin of that sale.
Okay. Define gross margin for us quickly.
Simple terms, net sales minus the cost of the goods sold. Basically, the profit on the actual product before overheads. So you're rewarding sales that actually make the company good money, not just move boxes.
That makes a ton of sense.
It's critical. Think about that Majestic Plastics example in the sources.
Oh, yeah. The reps hitting their numbers but selling the wrong stuff.
Exactly. Louise Shannon and Henry Sadowski, they were quota superstars based on volume, consistently hit their targets. But because their pay was tied only to volume, they just kept pushing the old, easy-to-sell, low-profit products. They completely ignored the company's newer, high-margin goods that strategy dictated they should have been focusing on. The pay plan was literally working against the company's profitability goals.
Wow. Paying people to sabotage your strategy. Ouch.
It happens more than you'd think if the plan isn't aligned.
And it's not just about profit margin, is it? It's also about the customer relationship itself.
Definitely. We're seeing a growing trend of baking customer metrics right into the compensation pie.
Like satisfaction scores.
Exactly. Companies like AT&T, Siebel Systems, IBM, they started using customer sat scores, maybe retention rates, as actual factors in determining part of a salesperson's pay.
So you're incentivizing them not just to make the sale, but to make sure the customer's happy after the sale. Build that long-term loyalty.
Precisely. It shifts the focus from just the transaction to the whole relationship, which in many industries is far more valuable in the long run.
Okay, and what about when it's not just one rep? Selling is often a team sport now.
Increasingly so, especially in complex B2B sales. And compensating teams fairly, that's tricky.
I bet.
Sources point to a few key principles. One, the reward has to be shared, obviously, but a good chunk of that shared reward needs to be variable, tied to the team's success.
Okay, makes sense. Shared risk, shared reward.
Two, you need what they call role-reward congruence. Basically, the pay potential should match the difficulty and importance of each person's role on the team. The lead strategist maybe has a different incentive structure than the technical support person.
Got it. Fair pay for the specific job done within the team.
And the third one, this is the toughest. You often need some form of peer evaluation.
Ooh, teammates reading each other. That sounds potentially awkward.
It can be, but it's often necessary to figure out who's really pulling their weight and who might be, well, the freeloader. If one person is coasting while the others carry the load, but everyone gets the same team bonus, that kills morale faster than anything.
Yeah, I can see that. Okay, so stepping back, if you're actually sitting down to design or maybe just evaluate your company's plan, what are the absolute must-haves?
Yeah.
The core criteria.
The sources really boil it down to two key things you should base rewards on.
Okay.
First, reward factors the Salesforce can actually control. Things they do. Calls made, demos scheduled, displays set up, proposals submitted, activities.
Right, things they are directly responsible for.
Second, reward factors the company can reliably measure. Sales dollars, yes. Gross margin, yes. Market share gains, maybe. Customer satisfaction scores if you have a good system. If you can't measure it accurately and consistently, you can't really base pay on it fairly.
Control and measurement. Got it. Now, what about just the overall level of pay? How much money are we talking about?
Yeah, this is crucial. The sources make a strong point that often the total amount of compensation you offer is more important for attracting and keeping top talent than the specific method, the exact mix of salary versus commission.
So getting the overall number right is paramount.
Hugely important. We saw that data from 1999. Obviously, the dollar amounts are way outdated now, but the principle holds. A senior rep in banking back then, median earnings around $177,400.
Wow.
Compare that to hotels and lodging. Median was $49,100. Huge difference.
Massive disparity.
And that disparity dictates who you can even attract to the job. That principle is likely even more pronounced today. The level of pay sets the bar for the kind of talent you can bring in.
Okay, so let's say you've designed this brilliant new plan. It's aligned, it balances security and incentive, it focuses on the right metrics. What are the final steps to actually make it work?
Implementation is key. Don't just drop it on people. First, you absolutely have to pre-test the plan.
Meaning,
Run the numbers. Use historical sales data from the past year or two and simulate what the company would have paid out under the new plan and, just as importantly, what individual reps would have earned.
so you can spot potential problems or unintended consequences before it goes live.
Exactly. Does it cost way more than you thought? Does it accidentally penalize your top performers? Find out before you roll it out.
Smart. Okay, what else?
Second, introduce the plan very carefully. Give people plenty of advance notice. Explain the why behind the changes. Allied Signal, when they merged with Honeywell, did this really well. They actually phased in the new plan over 2 full years, and for that transition period, they showed reps their paychecks calculated under both the old plan and the new plan.
Seriously, side by side?
Yeah. And crucially, if a rep actually earned less under the new plan during that initial phase, the company made up the difference.
Wow, that builds trust.
Huge trust builder. Because, let's be honest, the default reaction from any salesperson when you announce a new comp plan is suspicion. They assume you're trying to figure out a way to pay them less.
Yeah, that makes sense. Got to overcome that skepticism.
Absolutely. And the final step is ongoing. Evaluate the plan every year. Does it still align with your strategy? Is the market changing? Are competitors offering something different? You can't just set it and forget it for 10 years.
Right, back to that initial problem. Constant vigilance. And we should also quickly mention those indirect benefits again.
Definitely. The non-cash financial stuff. It adds up. Back in '99, the average was over $7,600 per rep per year.
Things like health insurance.
Which almost everyone offered. 96% of companies. Group life insurance, dental. That stuff matters, especially for reps focused on security. It's a big part of the total package.
Okay, so pulling it all together.
It really comes down to this. Compensation is where your strategy hits the street. It's the engine that drives the behavior you need to achieve your goals, whether that's grabbing market share, boosting profits, building customer loyalty, whatever.
But it needs constant attention.
Constant vigilance, because the second your pay plan gets out of sync with your actual business objectives, you risk having your entire sales team running hard, but in the completely wrong direction.
And that vigilance, that pressure, it really comes to a head around quotas, doesn't it? Especially quarterly ones tied to bonuses.
Oh, yeah. Quota pressure is intense.
We saw some commission plans that are aggressive, kind of capping earnings. But even with standard quotas, you get manipulation.
It happens. To make sure they hit that target, secure that bonus right at the end of the quarter, what do some reps do? They might persuade a customer to place an order a few days early, predating it to pull it into the current quarter.
Or delay finalizing it.
Or delay it, post-dating it, pushing it into the next quarter if maybe they've already hit this quarter's number or need a head start on the next one.
That short-term gaming of the system, it feels kind of ingrained in some sales cultures.
It can be.
So the final thought for you listening, what are the hidden costs of that? When reps manipulate order timing just to hit a number, what does that do to your company's inventory planning, your financial forecasting, your overall long-term view? Is the short-term gain of hitting the quota worth the potential chaos it creates down the line? Really makes you think about how robust and how manipulation-proof your own incentives truly are.